Welcome to Trusted Talks. I'm Alex Bangash, the founder of Trusted Insight, the world's largest platform for institutional investors. Today, I'm here with a very special guest and my friend, former Y Combinator partner, Garry Tan. Garry is the perfect example of an entrepreneur turned venture capitalist. He studied computer science at Stanford University, and from there went on to become one of the early employees of Palantir. He co-founded his own company, Posturus, which was acquired by Twitter in 2012. Garry joined Y Combinator, the accelerator that fostered and funded Posturus. As a partner there for 5 years, Garry has helped over 700 startups scale and fundraise. Now, Garry is the managing director of Initialized Capital, which invests in true early stage VC. Garry, thank you so much for being here.
Thanks for having me.
Let's begin by talking about your journey to YC and the present. Your professional life has been a perfect arc from being an engineer to entrepreneur to a YC partner, and now the managing director of Initialized. How has your experience in nearly every stage of the tech process come to inform your investment decisions and philosophy at Initialized?
Yeah, you're too kind, Alex. I think from a high level, when we started our startup, by then I had spent years sort of working at big companies and seeing the inside of a hyper-growth startup, now a unicorn, from sort of 10 people up to about a few hundred people. And the thing that really struck me after starting my own company and then now working with so many companies today is that the fundamental piece of going from, as they say, 0 to 1, it's the same whether you're a product manager or lead engineer or, sort of someone who's in the thick of things building it. Fundamentally, going from 0 to 1 is still the same process. And then the main difference is that, and this is something that venture capital and tech has broadly figured out the past 15 years or so, is that those people, the builders, the people who can sit down, make a great product, a great service from scratch, engineers, designers, product people, those are the people who can now be the business people as well. They can actually raise the money, they can manage people, and often what we're finding is they're actually among the best to do that. And that's sort of the biggest sort of sea change that was most surprising, that is most true sort of seeing every stage of it. When we became founders, it was a lot of what I did for Palantir and what I did at Microsoft, but plus this added layer of complexity around managing people, around getting press, around raising money and managing the capital side. So the difficulty level goes up, but then the people who are the best at building product and services, they're often the best founders to kind of come along. And we've seen that with, whether it's Zuck or Larry and Sergey and, now Brian Chesky and Joe and Nate at Airbnb, or, Drew and Arash at Dropbox. There's just so many examples now of that. And that's frankly why I, work as a venture capitalist now. It's that we get to work with people who are just like us and then help them basically build their dreams.
It's really amazing that you should say that, is that some of the best CEOs or best companies are founder-led, and we're now seeing an analog of that, and perhaps you can expound on that. The analog of that is the best VC funds tend to be founder-led as well. So whether it's Mark Andreessen or Peter Thiel or Josh Koppelman and now yourself. Why do founders find it easier to work with founder-led VC firms?
Yeah, I think at the end of the day, you really want someone who's along with you, who's kind of seen the sort of 10,000 landmines that invariably could, hurt your startup or kill your startup. And so, the ideal is someone who's been in your seat, who can, the famous Elon Musk quote is always, they've stared into the abyss and, faced death, right? Like you've eaten glass, right? Like it is such an intense experience, as you know, and having people alongside who, it's not like this intellectual exercise, like they've been in that situation, they've, lost one of their lead engineers, they've lost one of their best customers. How do you feel on that day, right? Like things are all lost, and yet, a lot of it is managing the emotional highs and the emotional lows, and having someone alongside there who can sort of even that stuff out and help you get through. That's one of the key things for startup advisors. That's the job, actually.
And not so much getting the best terms or getting the best liquidation preference, but getting a partner.
Yeah,
for
that stuff makes sense for PE. Honestly, PE makes sense because you have to protect the downside, and then here, because of the power law, you can only lose 1x of your money. But the true misses, if you're a venture capitalist, is missing the 100x, the 1000x. That hurts far worse than at worst 1x, right? And so there's no value investing at this stage. It's entirely, are you in the right companies? And so given that, it's just a different sort of mindset.
How would you say, and that brings us to a good question, where we hear LPs and GPs talk about the valuation, the rise in valuation, and where we are in the cycle. What are your thoughts on the future of venture capital and kind of where you are investing?
Well, I'm continue to be super bullish about early stage. We wouldn't be running an early stage firm and continuing to do so if we weren't. I think the frustrating thing the past few years is certainly the later stage markets have gotten a little bit overheated, and we've certainly seen really meaningful companies raise at higher valuation than they should, and then it's just taking longer for them to actually have their growth curve fulfill their previous valuations. They're getting there, which we're excited about, but at the end of the day, we're going to keep doing what we do, which is meet small teams of 2 or 3 people, maybe with a few employees, but often not, and try to be their first check-in. And at the end of the day, no matter what happens, once they get to that level, it's already an outrageously high multiple for us. And so, what happens at this end of the market, it just kind of, we feel the tug of it, but it's not existential. Like, these companies are fundamental businesses that continue to grow. We've
also seen that most of the traditional venture capitalists are no longer investing at the stage you're investing. In some sense, we've seen, like, there is grade letter inflation. We've now seen round letter inflation, where the Series A and B are the fourth or fifth round of financing. So how is that advantageous to you?
Well, seed feels very, very different in that it's certainly more, cooperation and a minimal amount of competition. And then on the flip side, what we're finding is that the A guys who are traditional A players, they used to write $5 million checks or $3 million checks. Now they're writing $10 to $20 million Series A's. Hearing about $20 million Series A, that kind of boggles my mind on the one hand. On the other hand, it means that now there is sort of this earlier A, and then there's the post-seed. They're just different rounds of funding that are sort of popping up in between, and that means more opportunity. And they're just, there were lots and lots of seed players who were writing checks of $50,000 to $200,000, but the middle stage, writing $500,000 up to a few million, there are fewer. And so the opportunities are actually, that's where founders particularly want, capital, and that's someplace where we think there's a lot of opportunity right now.
That's great. We've seen that venture capital has gone from being an asset class for starting companies, traditional venture capital, to more to growing companies. So venture capital has become a shade of growth capital,
right,
where it seems what you're doing is the true starting companies and not growing companies. With that, I'd just like to understand how you've been so successful in funding some of the best startups in a wide range of sectors.
Yeah.
I mean, you have one of the best food companies in Soylent, some of the best on-demand companies like Instacart, the best Bitcoin company in Coinbase, and many others, including a couple of the best companies in enterprise, including Slack and Zenefits, amongst others. So how do you approach not knowing which sector will take off?
I think a lot of people really love to ask investors what the next hot thing will be, and when founders ask me that, I always say that's not really the job of the investor to prognosticate. In fact, the best way that we found all of those companies, frankly, it came from the reverse. It came from the founder. In the case of Coinbase, for instance, Brian Armstrong was head of anti-fraud at Airbnb in 2011. So, still, newly minted unicorn, still a 30x increase in his employee stock at the time. But in 2011, he decided, I'm going to quit Airbnb and pursue something that I think is a bigger opportunity. And the reality of it is, he was right. He saw in the blockchain and in Bitcoin this huge greenfield opportunity, and he saw it years before any venture capitalist saw it. And so that's really how you can actually spot the future. It's in the most talented people, at the best places, the best builders out there. They're the ones who are quitting their jobs and staking their careers on these new platforms, new technologies. And it happens years before you read about it in TechCrunch. So, at the end of the day, that's our MO. There's not really a shortcut beyond being in the right networks and then meeting people face to face. And even if, the hardest thing for all venture capitalists, I think, is getting that email in your inbox from, whether it's, it might be a warm intro, it might be a lukewarm intro for a given company. And you're reading through it, and, your knee-jerk reaction is, in 2011, the version of this would be, I've heard of Bitcoin, I read about it on Hacker News. A lot of the commenters say that maybe it's not for real. Maybe it's not something that's a sustainable business. People think that it's a pipe dream. And the job there is to say, what, this founder is an incredible founder, and I'm going to set aside what conventional wisdom is, and I'm going to actually meet them. And if in that hour they can convince me, then they're going to be able to convince a lot more people.
Great. So it seems that VCs always have these three buckets. They're either betting on products, or they're betting on markets, or they're betting on people.
Yeah.
So I think you're squarely in the people.
Yeah, exactly. At the seed stage, I mean, the funny thing about Coinbase is that if you bet on people and they have the right market and they have the right track, they've built the right product, then that's it. That's what you want. And so Coinbase came along, became sort of the best name in Bitcoin on the internet. And once venture capital came in and started investing in that space, suddenly you saw all manner of sort of Bitcoin fund to come up online. But frankly, at that point, you could only invest in the fourth, fifth, and 10th sort of Coinbase competitor, none of which you really hear about at this point. And so, it matters. People matter. Like, that's where you want to be.
It's also a great story on how you decided to invest, which kind of, perhaps you can share that anecdote. I feel that, really a good example of how you're working very closely with founders to solve their problems.
Yeah, I mean, really, by the time that we invested, at Demo Day, it was not the, and this is a good measure of, whether or not great companies are hot. It's true that great companies are sometimes hot, but ones that are not can also be great too. So, Coinbase wasn't the hot deal at Demo Day. It was a great one though. And, afterwards I just met with the founder, and the first sort of office hours that we did after Demo Day, they were pretty routine. They were how to do product, how to manage your first engineers, how to hire them. But it was about 6 months in before they kind of hit that inflection point where they said, oh, well, Bitcoin price sort of went up about 4x, and we're selling out of Bitcoin every morning. And it was at that meeting that we said, you know, let's drop everything. Let's solve this working capital constraint. And so we wired him another couple $100,000 to get him out of that working capital constraint. And then let's work on the Series A pitch right then and there. And that's when Fred Wilson from Union Square ended up joining the board. It was a great, really fast process for them, and it was absolutely the right thing at the right time.
Yeah, good. And Fred is really proud of that deal and proud of their thesis. So it's great that you worked with things. What are some of the other examples of conviction that paid off for you, and conviction in founders, where you went out on a limb for somebody, which you so often do, Garry? And I think that's why you have such a cult-like following in Silicon Valley.
Oh, thanks, Alex. I think the other one that is the funniest is actually with Instacart. So obviously Y Combinator is a 3-month program, and about a month and a half, we were already a month and a half into it at the time. And so no YC company had ever gotten in. I don't think anyone's gotten into YC this late since. But I guess that goes to show how special Apoorva and Instacart, as a company and as a founder, that these people are. I mean, we were introduced to them through other YC alums, which again kind of goes back to the people. It's really, really great 10x engineers, really, really truly special founders. They clump together. They hang out together. They're friends. They go to the same schools. They work together. And we were introduced to Apoorva through the founders at Firebase, which ended up going on, and that team kind of runs a big piece of the Google Cloud Initiative now. But at the time we didn't know. And
yeah, they had a big win.
Yeah, exactly. And I just hung out with them, was working with them at YC just the year before.
Wow.
And they came in and introduced me to Apoorva. And Apoorva said, hey, I know this is later than anyone's ever gotten into YC, but I want to be in YC. And I said, well, it's so late, it would be really, really hard. And for Apoorva, he's the kind of founder who says, well, that means that there's a shot. And he ended up actually sending, a 6-pack of beer to me using his service. And so, I'm just at YC doing office hours. Someone drops a 6-pack of beer. It was 21st Amendment Stout. It was really, really tasty beer, actually. And I said, well, what is this? And he said, well, he showed me the driver app, and he said, this is Instacart. Someone hired me off of Craigslist to do this, and then he took off. Sure enough, I went back and downloaded the app. He gave me an app link to try it out, and it had 10,000 beautiful photos with pricing data, with inventory, and you could put in your credit card, and it would get sent to one of 2 drivers operating in Mountain View for about 100 beta users. And so a lot of people had been trying to do grocery delivery, but this was the first time we'd ever seen someone do the full stack and actually have it working. And so it was kind of like a basic intelligence test. We just had to email my partners that day, and I said, guys, we have to interview him. And he was in by the next week, and it's one of the most valuable companies that YC's funded since. So we're all pretty glad that happened, honestly.
Great, with Mike Moritz on the board there. So we heard a little about your YC experiences, but you've also now run institutional venture funds. What have some of your learnings been, as prosaic as they might be, from running institutional funds, and what are some of the things that you think you want to do?
I mean, I think one of the things that has become clear over time is actually it's not enough to be in the right companies. You also have to be able to put together the right deals. And so, things like percentage ownership matter. It's not about protecting the downside. It's about properly pricing the asset at the end of the day. And that's something that when we first started, obviously we were very new and we had to learn. But at this point, we know founders really want to work with us. And so, as long as we put together something that's fair, that can get us a percentage ownership, that's the right thing for us. And so that was an interesting and tough lesson. I'm thinking the other thing that was most surprising, I would say, is that really the right team. So there are world-class builders, world-class product managers and designers and software engineers out there. But if they're pointed at the wrong market, it doesn't matter how perfect your execution is. And that's, time and again, a painful exercise to see people, so thoroughly and totally talented, just kind of bang their head against the wall over and over again. So over time, we've learned to be, basically, if we've invested, we're going to be a lot more upfront about maybe this is time to change your idea. Let's look at adjacencies. Let's try to figure something out. Like, let's not run out the clock on this one. You have X number of months. And so actually, we usually take the number of months they have left and then divide it by 3, which is the length of a YC batch. And say, if you think about it, you have 4 YC batches left to figure something out. And people have been able to do some really amazing things with that amount of time. And then on the flip side, sometimes the right thing is we meet a really great team and they're pointed at the wrong idea. It's perfectly fine for us to say it's a no for now. And we want to continue to meet with you, help you define the idea. And when you do find the right one, we'll be your first check.
Yeah, I think Drew Houston was trying to do a SAT software.
Yeah.
And Apurva's first idea was also, was it a legal software?
Yeah, that's right. So yeah, the funny thing about Drew Houston is that if YC had funded Drew for his SAT prep idea, then Dropbox wouldn't have existed.
Yeah, so it kind of goes back full circle to what Don Valentine and Excel and others things hey, the product matter, the market matters.
Yeah, exactly.
And to some extent, the product. So it is a combination. Although you favor the team.
Yeah, it basically takes a success basically takes all 3 things sort of working together in perfect unison, right? Like a great team, a great market, and then a great solution to whatever that problem is.
Well, Garry, thank you so much for taking the time. We really appreciate you speaking to us.
Thanks for spending time with me.
Thank you, everyone.